Hi, this is Randy Finney with Right Side of the Chart, and this is a late session update for Thursday, November 17th, 2022. It's 2:39 p.m. Eastern Time, so I'm starting the video and just go over just updates on some of the things I've covered recently. Right now we're at a point where I think the market is probably most conducive to active trading. That's in and out, long, short, sometimes several day trades a day, if that's your cup of tea. And if it's not, I'll give you my thoughts on where we might be going. Swing trading, really no new updates there, but typical swing and trend trading entails positioning for usually weeks. There's no hard definition, but I usually consider those trades lasting at least several days to sometimes several months and anywhere in between, with an average holding period of maybe a couple weeks, a few weeks. But that all depends on the security. Let's go over so let's talk about the active trading. That's initially not what this site started out to be. I've always done that, and when the market's more conducive, I'm going to share more of those shorter term setups. So this is that 60-minute chart. I'm zoomed in real tight. Hourly candlesticks on NQ, the Nasdaq 100 futures. You can trade QQQ in lieu of this, or any of the leveraged or inverse ETFs that are out there as well. And so you had a divergent high on the 60-minute chart. Here, let me take it back a little, and that lets you see the big picture, and then we zoom in. Kind of, that's how I work it. Go down, step down in time. This trend line, it goes to the left of the chart up here, and it starts on the mid-August highs. So you're not seeing that here. Again, that's to the left. That's your the primary trend line off the mid-August highs there. And you can see all these divergent lows, divergent highs marked. DL, rally, divergent high, correction, another divergent high, correction, divergent low, divergent high, correction, divergent low, rally. And in between, even a small one there. So you can see a little small divergence right there. It doesn't say DL, but that would be where I'd put it. And that's it. This is the a swing trading time frame. And you can see these are trades that are these are active swing trades. These are trades lasting. You can see the daybreak lines down here. Each one's a week, each where I'm going right here. There's October 31st, November 7th, 14th, so forth and so on. And so that was it. There's our most recent divergent high. We had some divergence that started to form, as I mentioned here, at that 11,785 resistance, that yellow line on NQ. Went through there, but the divergence not only didn't go away, not only did it get negated. By negated, it means you would have made up higher highs in the indicators. What happened? It got even larger, and then we had nice clean divergence. That's the best type of divergence, when you have these distinct peaks. There's a peak followed by a trough and another peak. That's the kind of divergence that usually leads to the trend changes. So, and as I say, there's no hard set rule, but typically the bigger the divergence, the more powerful the ensuing trend change. And so that's that. And of course, that's on any one particular time frame. Then what also is a completely different thing, but somewhat can be related, is looking at longer time frames. In other words, a divergent high or a divergent low on a daily chart supersedes a divergent low on a 15-minute or 60-minute chart. And the weekly divergences usually lead to even more bigger trend changes that they're more appropriate for a typical trend trader or a swing trader that likes to position for at least weeks or months at a time. Okay, Randy, so where do we go from here? That's $1 million question, right? Like I said, my convictions aren't super high, and that's it's put me to a pretty good extent in active trading mode. At least in the my primary trading account. But I think there's still a decent shot that we come back in here, back test. Now, to come and back test this trend line, that's a pretty big drop. That's a pretty aggressive target. It's going to undo a lot. It's going to undo this whole big pop right here. That was again technically induced, because we had divergence. We even had a little divergent low there at the time. Right there, you can see the positive divergence. But more so, we're coming off that big weekly divergent low and daily divergent low on not just QQQ, but all of them. SPY, IWM, they all had the divergence. So, that was there was a technical catalyst as well as a fundamental catalyst. And the fundamental catalyst, in my opinion, was a bit overdone if you're going to cite it. If again, in a vacuum, if you strip it apart and say, okay, well, that was when the CPI number came in slightly cooler than expected, but it was still, 7 point something percent. So we still have high inflation, and and the Fed's not going to, certainly not going to pull an all-out pivot on one data point. That they're going to. They're always reactive, not proactive, but they're also going to use multiple data points. And at best, we're going to just see a slowing of the rate of ascent. And of course, at some point, you're not going to keep seeing 75 basis point rate hikes indefinite. That would get us quickly to 10, 20% interest rates if it keeps going over the next couple of years. Even the next year or so. All right, so that's where we may be going, and then let's zoom in a little tighter. I'll just move on, and I want to cover a few other things for you. Look at a few sectors, some things that stand out to me. But so when we zoom in and then analyze this divergent high right here, you had this trend line. I spoke to this before, that I left that trend line there, even though you had a breakdown there that was in front of the CPI numbers. That was that spike, and there were enough reactions on there, and more importantly, some reactions recently. So we broke it. That was a pretty nice sell signal, and we've been stair-stepping lower. Are we going to go that far? Look, we could go way beyond that. Let me just loop over to the daily charts real quick of QQQ and reiterate, what as of now, what I'm looking at are my likely bear market rally targets. So I have two boxes, as you can see here. We have a red one. Let me change my tool here. Do a frame. Let me do a frame tool. So you have this red box. This is my most likely, highest probability chance that that's our bear market rally target zone. And we already kissed it, as I mentioned the other day. That was, I said you can start shorting there if you're a swing trend trader and you believe, like I do, that this market's going to new lows. And maybe not a hard all-in short. You can continue to scale in if we go higher. You've got the 200-day moving averages. You have the downtrend lines off the highs. And then you have big price resistance right there at about 317 and change. And then, a lesser chance that we could carry even higher. And all that would do at that point to go to the top of this range there at about 332, 333 on QQQ would only be a run-of-the-mill 50% retracement off the all-time high, where the last last bull market ended, and this bear market began. And that's not very much, and it's not unusual either to see the markets pierce the 200 days, and it clears out a lot of stops. Those that short the 200 days get stopped out. The market makers will run it up, play their little games. The algos will do that, and I'll tell you, here's the thing. You're in a bear market at this point. Back here and here, very few believed it. We believed it, or I did, and we were positioning and we were shorting bounce backs to those 200s. At this point, okay, everyone agrees that the Nasdaq's already had a bear market, and most do, or is in one. And so where I'm going with this is, now if the general consensus is that what tends to usually happen when you have such an obvious level, such as the 200 days, and once it becomes widely accepted, okay, again, that back here it wasn't widely accepted. Now I think it is. One of two things tends to happen. You either overshoot them, or you reverse shy. Because to just run up and hit the 200s and then turn around, is it possible? Absolutely, certainly possible. But it makes it too easy. It allows longs to milk every last cent out of that. The majority. The market doesn't let the masses make money. It just can't. It just can't be that way. It never is. So it's either usually going to reverse shy or overshoot them. And we'll see. I can't tell you right now. We'll know better if we start to move down and break support levels, or we start to move up. Now, on the flip side, the S&P 500, it did just the other day. Let me turn back on my boxes. It made a almost perfect test to the 200-day exponential moving average. That's the red line right here. You can see that. Zoom in nice and tight. Popped it. Made the ever so slightest intraday pierce, but then closed right below it, and that was also an objective shorting entry, and it's reversed so far. And that is, at the very least, usually on the first tag from below, when you really got below those moving averages, like right there, that was the initial tag. After that, dropped down to here. you usually get at least a brief reaction, and that's what you had. You were 2 days of reversal there, 2 days it pulled back, then it took it out. Then it ran at it again, tried twice to get through it, failed, and didn't stop going down until it got here. So that's where we're at. And again, I can sit there and all day long say this. That's my coin toss odds. That whole red box right there. Hopefully you can see it in the video. That's my most likely end of the bear market rally. If, again, that's a big if, assuming that I'm right and we're going to new lows. And then this is the certainly, still possible. So that's the whole range right there. And this is my most likely highest probability range. One way I might explain that to you better is, for trend positions, scaling in, I start scaling at the bottom, like, long-term accounts, IRAs and stuff. We'll scale up to the top here, but not continue to add, and then sit tight and start scaling out if and when we exceed that uppermost bounce target, which is around 430. That's the plan. And then what happens if we never go up in there? Well, guess what? Then I'll continue as evidence builds that the rally may be over to continue to scale in, because there's plenty of room. If we're going to go down and take out the lows and make a new low, there's plenty of a downside left in the market. All right, so that's all short-term stuff. I'll go back to the, let me just rifle through the near-term charts again. I'll show you I covered NQ. Let me try to find it again. So that, this was, today's setup. And this is how the trades worked. Worked really well so far today. Came in, this was pre-market, got that post out to you. I mentioned I fixed the chart. We were right there this morning at 11,540. I incorrectly typed that as the first target, but then I fixed that post and made a little comment section to it. So we went up, hit my minimum max bounce target. The time we hit that, I said I could easily see us, carrying up. There was a confluence of resistance. You had this uptrend line right here, that one. You had this downtrend line right here, that one. And you had that pretty big price resistance level, about 11,785 right there. So confluence of resistance, triple levels, and that's where we hit almost perfectly, and we reverse now. So the way it works is, look, if we can pop this clearly, that's going to be bullish. That's probably going to bring us up and maybe run at those previous highs. There's a reaction high there, but there's your previous spike high. But as of now, I think there's going to be more downside to come here. And I'm going to get to that in a second, show you a few things. And, you can go trade the 5-minute charts, work really well for trading, active trading. I just jumped down to NQ 5-minute chart. You can see I had a downtrend line today right here off the highs. That was an objective level. If you did go long this morning, like I did to play the bounce, you can see there was just a lot of resistance there. You can see that price resistance there, downtrend line resistance, and even a secondary resistance level overhead. And you also had an uptrend line off the lows today that was all taken out right there. So that was it. And then boom, this was the first support on the way down, or was and still is. And that's a good place, if you played just a quick pullback trade. And that's, for me, that's active trading mode. Cover there and then decide, wait to either reshort or wait for a break of that level and then take it down further. But that's it. So you can see we're kind of ping-ponging between these levels. And even if you don't trade futures, I recommend to watch those charts. And just like even if I'm trading NQ only, I'm still going to watch QQQ. And here's 5-minute chart. There was a downtrend line taken out there, and that was near-term bullish. 60-minute chart I gave you this morning. We were right here in pre-market, exactly at the low. And that's where I had 2 arrows drawn up, one minimum to right here, that 284.38, and I had the second arrow, you'll note, was just a little bit higher, and that's where I figured we might carry on the max target, and that's so far what happened. So, but we're back to support, so I can tell you right now the market's at support. Where we go the rest of the day, I have no idea, because we're at support. However, where we go in the coming days to weeks, really starting to lean a little more towards limited upside, or maybe this was the highs, and we start going down. Let me show you some of the sectors, and I'll show you why real quick. Before I do that and leave the indexes, there's the 60-minute chart of SPY. but I didn't cover it earlier today. Divergent high was confirmed, negative divergence right here. So we had a divergent high into resistance, and now you can see we've got a little minor downtrend line right here. So if they can pop that, it's going to be bullish. There's also a little minor support right there. So pop above that's probably going to run us back up there. Otherwise, we haven't done that. I like to say resistance is resistance until unless broken. So we're still below that. Here, you can see it right there, the downtrend line. And an obvious target for a near-term swing trade to the downside would be this uptrend line and that intersecting 385.40-ish support level right there. So if we go through, here's a support zone right here. We bounced off the top of it today. We take that out, and that's probably what we'll hit right there, and then bounce off the trend line and or 385.39 if we get there. And again, that's 60-minute chart. But here's what I want to show you on sectors. So there are 11 sectors in the S&P 500, the biggest one being technology. This is what it looks like on my daily chart. It's going to mirror QQQ. So just like QQQ, it's a little shy of the 200-day moving average. Let's see, so far we retraced in the entire bear market from the highs back in at the end of the year. Last year, we're a little shy of the 38.2. So tech continues to lag on a relative basis as far as retracement, but it's been pretty strong on the way up recently because it led the way down and was more oversold. So you're having a lot, and it had the most constructive charts. Most of your big FANG stocks did. But let me show you the other sectors. So we have XLV, healthcare sector, which just recently, as I pointed out the other day, hit the 61.8 retracement. And there's your typical retracement ranges in a counter trend rally, again, assuming that we're in a bear market, a larger downtrend with more downside to come. So twice it's retraced and hit that 61.8 fib. It capped it right here. It capped it right, well, that wasn't, at the time, it wasn't the 61.8 fib, but it's price resistance now. So here, I'll show you. So these are just the fibs, just kind of giving you an idea. And so, it's like I always use the analogy. I use a lot of analogies. One of those is like a case, a criminal defendant case, where you have the prosecution and they have to, have the burden of proof, and they have to show beyond a reasonable doubt that the accused is guilty, right? Otherwise innocent until proven guilty. So in a bear market, I'm looking for evidence that shows we are still in a bear market. If you start to see, 7 or 8 of the 11 sectors in the S&P 500 all taking out the 61.8 fibs, heading back towards new highs, taking out price resistance levels, well, then, hey, guess what? The downtrend may be over. You may be looking at a new uptrend. But as of now, this is that same price resistance level I just showed you on XLV. And remember, XLV is the second largest sector. That's that number's at 134.70, and this whole white shaded box is just really the trading range we've been in. This looks like a big top to me. After one of the strongest bull markets in history, everything's been stalling out for the last couple of years, and you've had 2 failed breakout attempts to go to new highs, both shot down and rejected. They proved to be what we call false breakouts or bear traps, or bull traps, I'm sorry. And then you also had 2 on the downside. So right now it's anybody's game. Bulls got smacked down twice, and the bears got rejected twice when they had the opportunity to take it and run. So back into the range, and all I can tell you is that when you're in a range, no range lasts forever, but it's pretty objective to be going long at the bottom of the range and then short up at the top of the range. And we're close to the top of the range now, and we're also at the same level that's capped the last 3 advances, going all the way back here to May right there, that May rally. There's one in August, and here's where we are now. So you're at Fibonacci resistance, and you're also not too far from the top of the range. You can pop that, and then it's going to run up and test that 137 level. But one other thing, and we're going to look at several sectors, something that stood out to me when I was going over the charts today. Let's see the PPO down here. Let me put up the histogram. You can see it better from a visual representation. Histogram shows when the PPO makes a bearish crossover. So you have the PPO down here. You have the orange lines, your PPO line. The white line's a signal line. So when the orange line crosses down below the white line, that's a bearish crossover. And when it crosses up from below, that's a bullish crossover. And these histogram bars will show you when they cross. It goes from green to red or red to green, right? So And what you want to look for too are high levels. So here's your zero line. So anything above the zero line, these are high level bearish PPO crossovers. So let's take a look at what happened. We have one that hasn't happened yet, but you can see, well, it actually has. I take that back. You can't see it probably in the video. I can, a little red blip. Now the day is not over yet, but when you look at the histogram, you can kind of see when it's falling, it means the PPO line has now went from up to down. It's turned over. The slope of the line. The line's now pointed down, and crosses at that point, they're not guaranteed, but they're usually, you can pretty much see them coming. Sometimes it looks like you're going to cross. You get a last minute, the lines kiss and it stalls, but ultimately you can see as the momentum slows, and that's what this is all about, guys. These are momentum indicators. That's why you always see them on my chart. They're very useful for predicting trends, and that's what we are. We're swing traders, trend traders. You can use these same momentum indicators on a monthly and weekly chart and be a long-term investor and only make a few trades a year, if that, sometimes every few years, and do excellent. They're one of many tools, but they're pretty darn reliable. And so what I'm looking at, again, I'm looking at the high level crossovers. That's what I have circled here. High level meaning well above the zero line, and we're going to show you right here. This was the last one. We went bearish right here. So that told you right at the highs there, get out short if you were just using this indicator, that is. This one just crossed, so here we are. That's the first sell signal since right here, the biggest drop that we've had pretty much all year, one of the biggest drops there in healthcare. Time before that, that was below the zero line. You still got a bearish crossover, but and it still led to a drop right there. But this was the last, before this one, the last high-level bearish PPO crossover right there. So you get the picture. Pretty good track record, right? And the one before that was right there, and the one before that above the zero line was right there. So, okay, that's one sector, right? So we don't have it in XLK, but we do have it in XLV, the second largest. XLF are the financials. Same thing. It hasn't occurred yet. Let me put my histogram back up. But it looks like it's inevitable. Again, nothing guaranteed, but the PPO has rolled over. It's pointing down, poised to make a bearish crossover. The last time we had a bearish crossover, a high level was right there, and we had that drop. Time before, well, this one was on below the zero line. So let's just look at these two because they were the most recent. But you can, there was one right there. Even though it was below the zero line, it was still a bearish crossover, one right there. And you get the picture. All right, so we have, that's 2 out of 3 right now that are either crossing or look like cross is imminent. XLC is really below. This is the communication sector. This has formerly Facebook, now Meta and Alphabet. It's really those two stocks alone, at least back here when I checked last, it's been a couple years, they made up almost half of the entire sector because they were so large. But on this one, I look at the PPO a little different. I have a red line at 0.36, and that delineates bullish and bearish trends. So when the white line, the signal line, is above, which it was from here all the way to here, the trend is bullish. Then you got a crossover, and it said the trend is bearish. And guess what? Every time you came up, boom, boom, rejected, rejected, rejected. And so that one's still below. And so that's the takeaway I'm using on this one. So that's, let's just say I'm going to give that, if we're just playing a simple game, bullish or bearish, I'm going to say so far, what is that? 3 out of 4 bearish. XLY, consumer discretionary sector. Let's see what we have there. Don't really have much marked up. This one's coming off a nice divergent low like everything else, but so I'm going to say neutral. I'm just going to skip it. I'm not going to force anything here. XLI, this is the industrial sector. Think of companies like UPS, Honeywell, Raytheon, Union Pacific, John Deere, Lockheed Martin, Caterpillar. They're all in this one. Boeing, GE. So obviously important companies. These are like the Dow companies. A lot of these guys are in the Dow. And that looks to me, I don't know why I keep parking the PPO histogram, but there it is. You can see what appears to be a very likely and imminent crossover because the lines have now turned down and are heading down at a pretty quick clip. Last bearish PPO crossover was right here. You decide if you wanted to go long or short at that point in time, because that's what happened. The next, we had a bearish one there. Again, it was lines were below, but it was still a bearish crossover. Last time before, when it was above the zero line, was right here. So, and again, zero exceptions, by the way. You can see these are I'm making a mess here. I'm trying to show you the red areas are when the lines cross and we're below. And so it captured these bearish trends, 1, 2, 3. Okay, so making some, observations, not a prediction. Call it a prediction, call it what you want. But so this is what's keeping me in the bearish camp. Oh, and if I didn't mention it, some of these like healthcare, I mentioned the resistance levels, price resistance. But there you had a downtrend line. You had a very brief shallow breakout, which I think will prove to be a false breakout. And you also had a uptrend line, a very clean one, just like you had an uptrend line right here. When that uptrend line broke, there was your sell signal. It gave you that. And so look, if we break this trend line, we're also going to fail. This will be a bull trap, aka false breakout. I might not have mentioned it, but a lot of these guys are also running into key fib. This is a 61.8% Fibonacci retracement line right there of the entire move down so far in the bear market. I might have forgotten to show you that on financials. I think I did. Financials just got rejected off the 50% Fibonacci retracement level as well. So we already covered industrials. This is utilities. Again, you call it coincidence if you want, but almost every sector in the S&P 500 is at a key fib level, 38.2, 50, or 61.8, all of which are what I consider, and many do, well within the realm of simply a counter trend bounce and a larger move down. So again, we start taking out the 61.8s with the majority of sectors. Maybe something else is going on. Maybe the bear market is over. We're certainly well off the lows, so it's anybody's game right now. But when I flip over to this board, which has price levels instead of fibs, well, like everything, so many sectors coming off a divergent low, and that's bullish. As mentioned before, you get a positive divergence right there. That was a catalyst for this rally, but that rally has taken us perfectly back into the primary downtrend line off the bear market, start of the bear market right there. And so you're at downtrend line resistance, you're at the 200-day moving average, you're at the whatever fib it was, 50% I believe, whatever I just showed you, and you have a bearish rising wedge pattern to boot. Now we haven't broken down yet, but that's so if you're trading XLP, for example, you want to trade this ETF or any of the components. The top components in this one are Walmart, Procter & Gamble, Coca-Cola, Pepsi-Cola, or PepsiCo, Costco, Philip Morris, and those are the big names. And so you set a little alert here. This is how you do it. Set an alert, or if you're a active trader and you want to short XLP, you set up what we call a sell stop order. A sell stop will trigger get you short if you don't have a position once that level's taken out. And again, it looks likely to me. There are no guarantees. Sometimes these lines look to cross and then they kiss. The lines kiss, but right now you can see the PPO is rolling over, poised to make a bearish crossover. If you get a breakdown there, the last time we had a high level bearish crossover above the zero line was right there, and look at that. It coincided perfectly also with a breakdown of not just the primary uptrend line, but also back then it wasn't the downtrend line. It proved to be after that reaction. Well, yeah, we got a reaction there, but you can see so almost an identical setup. And back then, except this time around you have divergence on the RSI. You don't have it on the PPO, but you do have it on the RSI. That's why I drew a wedge here, that divergence line right there. So wash, rinse, repeat. And if this plays out the way I suspect it might, why not? We're in a downtrend, so common logic, if that downtrend's still intact, which by every metric I just explained to you it is, and it continues, and then it would only make sense that we go on to make a lower low, which means that the consumer staple sector takes out the previous lows. Most likely, not guaranteed, but most likely the entire stock market will, meaning the S&P 500. All right. Oh, so let me just finish it up there and just show you. Okay, so there was our previous High level bearish PPO crossover. I circled the one before that was right there. Oh, look at that on a trend line break as well. Isn't that convenient? And then that one there. Oh, look, same thing, trend line break. I really didn't even mean to do that. I was just circling these earlier, but this is it. This is technical analysis, and there are no guarantees. You take you miss 100% of the shots never taken. So you take the shot, and if you're wrong, guess what? You go up. When do you know you're wrong? Well, if we start going down, you get the sell signal, the break of the wedge, and then all of a sudden you reverse. You take out the 200-day, you take out the downtrend line, you take them out with conviction, a solid daily close, even 2 or 3 candles above. You take out the fibs. Then, hey, guess what? You just got sucked into a false breakdown. Until then, take it on faith. Let's not overcomplicate this. We're in a downtrend. This is as good as a shorting opportunity gets in a bear market for all those numerous reasons I just showed you there. All right, a few more to go. Energy sector. I know, I'm sure some are getting frustrated with this trade. It doesn't matter to me. Take it, don't take it. I pointed out when we first broke down here, and then I pointed out the back test right here on XLE, and then I pointed out that all we did is made a marginal new divergent high. Sometimes you break down, you never look back. At least till the first counter trend bounce. Sometimes you break down, you back test, and you make a marginal new high, and then you roll over. That's what's happened here. So now let's look at it from another perspective. I've covered that quite a bit. So a couple things happened. Number one, we made a slight, ever so slightly, it's hard to see it here. You can see XLE, again, the energy sector, the most beloved sector on Wall Street for months or for the last year. We made an ever so slight, but technically it was a pop to new highs. So 2 things happened there. Number one, that gave us a larger, on this time frame, a larger divergent high. This shows through on the weekly chart even better. This is a daily chart we're looking at here. But you had higher high in prices and equal or lower high in the indicators. Again, you can see it on the weekly chart right here. And there's your negative divergence, right? And a weekly divergent on a weekly chart will typically play out for a double-digit drop that's going to be measured in most likely months, not just weeks. And that would be my minimum target, a 30% drop down here to about 65, I think, on the energy stocks. I think there's a lot of hot air in that sector. Okay, so let's see. That's nothing I haven't covered with you already, but what I'll show you here, again, point of this video. You got it, PPO time. There's your bearish PPO crossover, right? It has happened. It's happened. We zoom in tight. This is a daily chart we're on. It's been about a week. We crossed over. It's a slow roll. They refuse. Those damn energy bulls refuse to let go, but they will. You'll see. Most beautiful thing in trading is a crowded rush for the exits, and I believe it's coming. Anywho, it gives you plenty of opportunity if you like me and you want to get on this. There's your bearish PPO crossover. Again, high level, there's a 0 line right here. Okay. Last one we had was right here. See it right there? We'll go from green to red. And, like then, it didn't play out right away, but it certainly played out if you gave it a little room and you're a little patient. There's your down move. And the time before that was right there, and that was right after trend line break, and that one did play out right away. And you got all of that, and that was that was actually a target laid out from before. So I don't know, it's not much else to explain there. Time before that, you can see the other bearish PPO crossovers. Sometimes you get this when you get in a trading range, they don't work as well. I like to see I like to see clean separation between the lines. That's where the histogram's clean. When you get in these choppy consolidation periods, the histogram, you tend to get more whipsaws. It's these clean hills I like to see. Those are the most reliable. And we're in a downtrend, so right now, bear market, so we're looking for bearish PPO crossovers, and that's what we just got. So bear with me. We only have a few more to go. XLU. Again, it's not going to move the needle as much on the stock market because this sector only makes up about 3.5% weighting, but it is still a sector of the S&P 500. Kind of just shows you what's going on. So you've got a nice clean uptrend line off the lows recently. You have the PPO rolling over, but it's got a little bit of room before it makes a bearish cross, but if it breaks that line, it'll probably do it. Last bearish PPO crossover was right here. Time before that, we had one actually right there. I didn't circle it. And then we had one right there. So, all right, you get the point. I don't want to beat a dead horse, but when I can go through 11 sectors of the S&P 500, and most of them, either some of them have recently made the bearish PPO crossover, but most it looks like it's pending. And once the tide changes in the market, you can see even with something like utilities, this isn't natural gas, but it tends to sure trade like it, not to the same percentages. This sector is either full throttle up or full throttle down. It looks like an escalator, right? The escalator was going up there, and now the escalator is going down, kind of all over the place, and that was a big divergent high. So that's it. Two more sectors. XLRE is the REIT sector. There, it's not happened yet, but you want to watch for it. Bearish PPO crossover and a break of the trend line would give you a sell signal. There was your last bearish PPO crossover, high level above the zero line. The one before that was right there, and the one before that was right there. So you decide. And again, they're marching out the bull parade on TV. I've talked about that recently. It's almost like an attack on bearish sentiment. Santa rally, seasonality, Fed pivoting. La-di-da-di-la-di, earnings holding up, but this is it. This is a definition of a downtrend. You're looking at it. When we start to take out previous reaction highs, key fibs, then we're back in an uptrend like that. But right now, that's not what we're in. We're in a downtrend. So your short rallies back into resistance. It's just trading 101. It's really, you can make this thing as complicated as you want or as easy as you want. I like to, and not just simply, you can't short every rally back into resistance. If you do that, at the wrong time, you're going to break several. You've got to realize, try to use this and everything else that we talk about, the divergences, 60-minute charts, the indexes, even the individual components. If I'm going to short a sector like energy, I'm not just going to look at XLE. I'm going to look at Chevron. I'm going to look at Exxon. I'm going to look at some of the oil and gas exploration production stocks and everything, and crude oil, of course, and natural gas too, and all that stuff together. Last one, XLB is basic materials. The smallest weighted sector, at least as of the last time I did the updates on it. But you can see not yet there, but looks like if we get a bearish PPO, the PPO has turned down. I can see it here. It's rolled over, hasn't crossed over yet. The last time we had a high level bearish PPO crossover, it's right there, and then right there, and then right there. There. All right, you get the picture, right? All right, so next one should be coming soon, and right now, this one's kind of pushing the upper limits, but it's not, see, you can't take everything, okay, well, there's the previous reaction high. If we go this high, now we're no longer in a bear market. It certainly doesn't help the case. You put in a divergent low, this sector took out its downtrend line, but guess what? This is basic materials, okay? What is that? Well, that's companies that make things like steel and cement, concrete, aluminum, copper. This is the bane of Powell, I call it. This is the inflation trade. So the sector, if you want to pick one or two sectors to put away during this bear market and ride it out for outperformance, I think it's going to be this sector. So yeah, the fact that this one is a little bit stronger than most of them here, and you can see a full 61, and again, this is not mere coincidence. I didn't go over the fibs on each and every sector, but they're all right at fib resistance as well. So you tell me if that's coincidence that 11 unrelated sectors, each one with dozens of stocks within there, all happen to be right at or very near key fib retracement level, key moving averages, primary downtrend lines in many cases. Yeah, it's a little bit more than coincidence. So again, there's no guarantee that you won't pop it just because you're there, but when you are there, again, that's resistance, and in a downtrend, it's trading 101. Short rallies back into resistance, or if you're bullish, wait for a breakout above resistance to go long. All right, that's it. I'm going to leave you there. I'm going to show you one that I noticed lumber. This is kind of off topic here. I really just wanted to cover the markets and the sectors, but I did notice we've been building divergence here. I pointed out actually as a setup back here, we popped it, and there was the first target was hit, and I said you'd have to take out, or lumber futures would have to take out 451.50 to trigger the next buy signal. Well, they never did. But since then, we kind of set up this little minor downtrend line. We did just break out. There's an uptrend line forming now. Um, so yeah, I'm not in it, but that doesn't matter. I'm just pointing out it'll probably continue up at least at 450, 150 level. And I might get in if it breaks out or if it pulls back to this trend line. But I did want to say, nice divergent low right there. I think one of the things probably giving this one a little reprieve lately is the interest rates falling on long-term bonds and stuff, which help the mortgage rates come back down a little, might spur a little more home building. And that's it. But like I said, my main focus here was the markets, and that's where we're at. I think we could be... I may have possibly already started the next leg down based on everything I just showed you. The stock market, the indexes themselves, QQQ and SPY hitting my minimum bear market bounce target zones, the bottom of those, as well as most of the sectors making a pretty clear case, which I just spent 30 minutes talking about as to why to be short almost every sector in the S&P 500 right now. All right, this has been Randy Finney with Right Side of the Chart. Have a great day.